Hey, everybody, let's take a deep dive into this coronavirus thing here. So, I think the closest analogy to the coronavirus situation, which is the number one factor affecting the stock market right now, but if we look back in time, we can see that the SARS virus was pretty analogous to the coronavirus. There are differences, let's obviously, but that one had a big impact on the market as well. So here up at the top, we see the number of SARS cases. So when we look at coronavirus, we're way down here. We're way, we've only got, not that many. All right. The stock market's dropping though. And the acceleration up to this first peak, which I don't think we've got to in the coronavirus, then led the stock market to drop down a lot. Now, there's four different markets here. S&P, Hong Kong stock market, airlines, that one's down here, and consumer discretionary, that's here. S&P is right in here. So then the number of cases actually went down and then spiked up to its peak, came down, spiked up again, and then basically disappeared. Now notice what happened is the first blush of SARS is what caused the big dip. But in actual fact, the highest number of people who got SARS, the stock market's rallying. Let me explain why. You see, the market doesn't like uncertainty. And it was the uncertainty of how bad is this going to be that caused the bear move. Now, once they said, oh, it's going to be bad, but it's not going to be like the flu of 1918, it's not going to be that bad, where 700,000 Americans died and 18 million died around the world. No, it's not going to be that bad. It's going to be bad, but, it's not going to be that bad. So by that point, they had adjusted and they had factored in the negative news of SARS. And so the market started going back up again because it started to look at the economy and earnings and interest rates and all the usual sorts of things that it looks at. It's the first blush, the uncertainty that causes the bear move. Hey everybody, Courtney Smith here with our Wall Street winners. Hate to start out with something so depressing, but it is the number one factor affecting the stock market right now. All right, and this, of course, is always affecting the stock market. Okay, so let's take a look at the S&P for a second. Let's break this down. So I've drawn some blue lines here on this chart. Here's the high of the move. I'm going to say that this move started down here. We could say here, but I think down here is more likely to be true. And so we've had a tremendous bull move here since August. And then the market broke, rallied, broke. And there's a few things to break down about this thing. So first of all, this would be about a 1/3 retracement is the very top blue line right here. That would be a normal retracement is usually 50%. That's down here. But because of bullish seasonality and some of the other things that are happening, the presidential cycle, I would be surprised if we got down to 50% correction. And instead, I think we'll probably get a 1/3 correction. Now, that's a 6% correction from the top. I think a week ago I said we're going to probably get 2 to 5. So maybe we'll go, maybe we'll go a little bit further than that. Maybe we'll go to 5 or 6, something like that. But that's what this chart is telling us. Now, look in the lower right-hand corner, and you can see that Friday's price action came on a little bit higher than normal volume. We're seeing volume accelerate a little bit here. We haven't seen a big monster day like we did in December or we had back in September, but we are increasing volume, and that is a bit bearish. So look for a move down to, let's call it 3150 as our downside objective. Also, selling pressure just skyrocketed, and now we actually have buying pressure down towards the lows. Not low enough that I think it's a counter move, like I told you about a few weeks ago about how buying pressure was too high. It's not too low yet, and selling pressure isn't too high yet, but they're actually getting fairly close, which ties in with my scenario that we're not at the bottom yet, but we're going to be there soon. If the market drops for another week, we'll probably start to see selling pressure at too high levels, buying pressure at too low levels, and that'll signal the bottom of the move. Remember that once everybody's selling and nobody's buying, there's nobody left to sell. We run out of sellers and the market starts to move in the other direction. NASDAQ actually not as bearish. Notice the purple predictor here is slightly bullish. It's actually slightly bullish on the S&P as well. I find that kind of interesting, and once again, gives me reason to believe that this dip will only be maybe 5%, 6%, something like that. Seasonality remains on a buy signal, but I've now drawn a dark blue line there. I think if we break below that dark blue line, I'm going to call it neutral again. I'm going to put it back into a neutral category. So we do have some place where we say, okay, that's it. It's not seasonally bullish anymore. But now, when we look on our chart here, this is from Stock Traders Almanac, once again, highly recommended. You can see that this week should be a little bit bullish, but notice that really, if we follow the green line, which is the expected line that we're going to follow, we really start to go sideways all the way until June. The market just doesn't go anywhere. There's actually a little bit of a dip in May. So this is not a particularly bullish seasonal period. Normally, we would expect stronger seasonality into May, but what happens is that people are still thinking about the presidential election, and there's uncertain, and so they just don't want to do anything. They just want to kind of just sit here and hold still for a while. And then when we get into the summer, it starts to become clear who's going to be the president. Then we get into early fall, September, October, and we sit and say, well, maybe, I don't know, we should be worried. Maybe it won't be X person. And then once the election is over, then the market can take off again. Because once again, there's certainty in the market. The market hates uncertainty. It loves certainty. Even if it's bad news, that's okay, because then it can deal with it. Now, another, I think, big story is we're starting to see, we saw the yield curve turn negative again. This is big news. I mean, listen, as you know, I've been calling for a financial crisis in 2020. Now, how that fits with the presidential cycle? Well, this is reality, and the presidential cycle is related to past behavior. So we want to look at both of them for sure. But we're back to a negative yield curve. There's going to be a financial crisis. There's going to be a recession. And fortunately, well, if you're not a fully paid up member of Wall Street Winners, you should be, because we'll make a lot of money in that bear market. It's that simple. Volatility index is up over 18%, as you would anticipate. We should get over 20%, and then it'll start to come down. Now, several big changes here. I talked asset allocation. Took a big dive last week, but it took an even bigger dive this week. So look at the dramatic change here. We're really moving out of stocks and into bonds. So the selling pressure, people are saying, you know what, I'm afraid of this coronavirus. I think I'll buy some bonds because, you know what, I can always make money in bonds. I can always hold them to maturity. I know I can put on a trade that I don't lose money in. We also saw the risk indicator move down. So they're saying, I don't want to be in risky things. Let's go get us some of those utilities. Let's go get us some consumer staples. We just don't want to be in frisky type of sectors like technology, medical technology, biotechnology. They're sexy, but you know what? I kind of like Johnson & Johnson. The Europeans, maybe even a worse market than the U.S. They had been a bit stronger, but now they're starting to move lower. I think they'll just follow the U.S. lower. Bonds have taken off. I mean, we talked about this last week. I'm talking about it right now. There's some gaps on there, although gaps on this chart are not as meaningful as they are on a stock chart. But nonetheless, this is pretty interesting. Now, the bond key factors, with the exception of gold, everything is saying we're going to have lower interest rates. So let me go back to the chart that I showed you before. The yield curve, the Fed's not going to cut interest rates right now. The economy's fine. Inflation is fine. The Fed's going to stay steady. But if long-term interest rates are going down, then that means the yield curve is going to get even more negative. We're going to go back to the way it was in the spring. That's a recession. That's a bear market. This is incredible. Incredible. All I can say is it's incredible that we're back to a negative yield curve again. This is quite rare, but I think it's telling. Dollar took a plunge-o-rama here. Gold. As you know, I'm bullish gold. Fully paid up members know we have a small position in gold. I just think that because of the sharp decline in interest rates, that lowers the carrying cost of gold, makes it cheaper to hold gold. We saw the dollar plunge-o-rama on Friday. That's going to be helpful for gold as well. So I'm just bullish on gold. Also, federal deficits, huge federal deficits are bullish for gold as well. Gold key indicators, all of them going up except the middle one, which is commodity prices. But otherwise, we're seeing bullishness all over the place, particularly the bottom one. Crude oil down to the low 50s, which was what I was talking about. Now, it's still a bearish situation. Coronavirus reduces demand, particularly in China, which is the best marginal consumer. They're the ones that are most important consumer of oil. Marginal. And then the U.S. right now is the biggest marginal provider of crude oil. And both of those factors are bearish. But there's a lot of support at $50. We should expect a bounce here this week. Look for it to be kind of chop, chop, chop this week. And then let's take a look at it and see what the fundamentals are a week from now. But look for stabilization this week. And Bitcoin broke out of our 55-day channel. That would normally be a buy signal. We are seeing some safe haven buying of Bitcoin, although we're seeing more safe haven buying of gold. So this is not the best place to be a safe haven buyer. But nonetheless, it's a bull market, but I'm not long. I'm happy not being long. I don't think it's going to be that great of a bull market. So I think I'm going to just sit on the sidelines here for a little while and just kind of relax, not having a position, which is not a bad thing sometimes. All right, everybody, that's what I got for you freebies. Fully paid up members, hold on for just a minute, and we'll get into all of our trades and our more advanced analysis.